Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss what is a 702J retirement plan and really uncover, kind of why it's called a 702J retirement plan. It's just basically a fancy way for insurance agents to call a type of cash value life insurance plan, leveraging that cash value to supplement it for retirement. So, rather than just call it life insurance, which would scare everybody else off, they call it a 702J, or they might call it an IUL, they might call it a 7702 plan, a bank on your life concept, infinite banking, the whole different slew of different terminology. But I want to go over the concepts of it. What are some of the mistakes that are made when somebody tries to go into that plan? And if somebody's trying to leverage that plan, how to look at the 30,000 foot view and say, okay, I understand these negatives. How can I stop these negatives? How could I strip away all these different costs so that I could have a type of cash value vehicle that's going to grow on a tax-free basis, allow me to pull out these monies tax-free as well. So the concept of these plans are correct. The problem is you have many carriers that are horrible with offering these contracts, meaning that you have very low cap limits on certain contracts or very low dividend rates being paid out on certain contracts. You have very high expenses. You have agents that don't really understand the intricacies of these plans, so they'll just try to, force life insurance down your throat and talk about how great a death benefit is, for this type of plan. And what it's doing is it's eliminating a lot of those key factors to really accentuate that cash value growth. So what exactly do I mean by that? So this illustration is just a very simple concept of how a life insurance policy works. I used to draw it on the digital notepad, and I got enough comments saying how sloppy my handwriting is, so I figured, okay, I'd make it a little bit more digital, a little bit more clean. What happens is, let's say if somebody's placing in $1,000 into a life insurance policy, well, where do we have the risks associated with this type of plan? We have the risk, meaning that the individual is placing dollars into this plan, so he's risking $1,000 into this plan, and the insurance company is risking, in this example, $500,000 of a death benefit. So because that risk is larger, the insurance company is on a very large risk, especially in the beginning, is they're saying if this person's placing in $1,000 into a product, this has to at least suffice our actuarial tables to constitute what our risk is, what our net amount at risk is on the insurance company's perspective, saying, let's say he passes away after the first month. Well, now the insurance company is now out $500,000 of their death benefit in this type of plan. So this is why when somebody's underfunding a life insurance policy, yes, they can receive this death benefit, and yes, they could last them their entire life, but they're not trying to set this up for a cash value maximization plan. What I mean by that is when you're looking at the $1,000 that are going in, and we look at this little like egg circle shape, majority of the expenses are going into cost of insurance and other expenses. And that's what's going to correlate exactly to this death benefit. Whatever's remainder after that month, after that year, after all of these expenses are paid, that's going to go into the secondary bucket known as cash value. So cash value is important because the way that cash value grows and the way that a lot of insurance agents are leveraging this cash value component is they're saying these monies can grow tax-free. You could receive gains on these contracts linked to either dividend rates, interest rates, indexing strategies, that all that growth is going to grow tax-free as well. And then when it comes a time that you want to retire, you could actually siphon these monies out tax-free while receiving a tax-free death benefit like an umbrella over your head the entire time as you are trying to save up for your retirement. And that is where the mistake is made, because individuals try to leverage this as a one-size-fits-all product. So whether you're the consumer or whether you're the insurance agent trying to push this, what happens many times is the insurance agent's going to talk about why you need life insurance, why you need life insurance. They're going to max up, they're going to increase this death benefit amount because therefore it's going to be higher expenses, hence more commission in their pocket. And you're thinking, okay, well, they're telling me about this cash value component. I could always leverage this for retirement and then everybody wins. And it's not that simple. If you're trying to leverage a cash value maximization plan, you want to structure this a specific way to make sure that you're significantly reducing that net amount of risk to the insurance company, therefore significantly reducing the cost of insurance and other expenses, so that more dollars each and every month, each and every year are going into that cash value play. and you're able to receive good interest credits by the remainder left over on what you're not paying in expenses and what that interest credit is as well. So this would be a concept of a cash value maximization plan. And what did we do out of that chart on the other screen? All we did was just reduce this death benefit. And what it says is you have to be in compliance. And this is where you have like the 7702, 72E, 101A, all these different provisions of the Internal Revenue Code that will allow us to say this still has to be under the house of life insurance. If you want to receive those tax benefits, you have to make sure that's still qualified as a life insurance policy. You can't just throw $1 million into a death benefit plan of $1,000. There has to be a complete correlation between your cash value growth and your death benefit growth in there. And it has to pass certain tests to make sure that's still deemed under the house of life insurance. Now, in this example, this hypothetical example, let's say this person's throwing $1,000, but then we reduce this death benefit down to $100,000. Well, what did we do? We lowered the net amount at risk. We said rather than a $500,000 risk to the insurance company, we reduce this down to a $100,000 risk to the insurance company, but yet the individual is still placing that $1,000 amount. So therefore, now you have more dollars going to the cash value. So this is the concept of a cash value maximization strategy, is just saying, okay, well, we're going to just lower the death benefit to make sure that they could still place the same amount of dollars that they wanted to do on a monthly basis, and therefore get more cash value growth in there, get more growth to pull off from as a supplemental retirement income, as a tax-free supplemental retirement income. Once again, when we're looking at this cash value maximization, what are we trying to hone in on? Net amount at risk. We're trying to say how exactly can we reduce the net amount at risk to the insurance company, so therefore we further reduce these costs of insurance and other expenses as well. And that's where you have to think outside the box. So that's where a lot of carriers, only few carriers have really thought outside the box, and they've honed in on this net amount at risk concept. Once again, to take a step back, if you're looking for a death benefit plan, if you're looking for a permanent life insurance plan specifically for the death benefit, you should not be looking at a cash value maximization to try to, kill two birds with one stone concept. If you're looking for max cash value in a plan, you have to set up that plan as a cash value maximization plan. If you're looking for max death benefit, you have to set that up as a max death benefit plan. It's going to allow you to leverage your dollars the correct way. If you're saying, oh, I need to have $500,000 of life insurance, well, you could have plans that don't have any cash value associated with it, would last you to age 121, and will be half the cost of a whole life plan or an IUL plan to try to blend it all within the same sort of concept. So I hope that all of that makes sense. I just want to really make that point is if you're looking for life insurance, if you're looking for death benefit, that's an entirely separate avenue that we would ever recommend for you than going with a cash value maximization plan. So now what do we do a little bit differently in-house? And what am I talking about regarding that net amount at risk? Well, a couple of carriers have really honed in on that net amount at risk. And what happens is you could have that same amount of death benefit, but how exactly does this death benefit get paid out can significantly reduce those costs of insurance and other expenses. So on the other screen, we had that death benefit at $100,000, still with the $1,000 in there, but we had a different net amount at risk than we do with this new screen. And what exactly is that difference? And this is where those carriers that we spoke about, that I was talking about, they honed in on that net amount at risk, and they said, okay, you could have option A or company A that says you're going to have a death benefit of $100,000 that will go to your beneficiaries. Well, what about those individuals that only want to maximize out that cash value? You want to stay in compliant, making sure that this does not qualify as a modified endowment contract, meaning you're out of compliance on a life insurance standpoint to receive those tax benefits, but you still have to correlate your death benefit appropriately to those criteria. You have company A that says we're going to pay this death benefit out in the form of a lump sum, or company B that says, we understand the net amount at risk is going to be the most important aspect. We understand that individuals that are trying to set up cash value maximization plans, death benefit is going to be the least of their concerns. So how exactly can we pay out this death benefit in smaller increments and make sure that we're significantly reducing the net amount of risk? And that's exactly what's happening, is we're finding the best carriers that have patent pending designs on these contracts that say, rather than pay out lump sum that has a higher net amount at risk, we're going to find the one that pays out up to a 30-year time frame off of that same $100,000. Or let's say if it was $300,000 for easy math, and we're utilizing that for 30-year time frame, well, this is going to pay out $10,000 to their beneficiaries every single year for the next 30 years. So therefore, the insurance company gets to hold onto the money longer and therefore has lighter cost of insurance and other expenses into this plan. So it allows you to say, if I'm throwing dollars into this plan, my cash value, I'm able to net out that cash value. The remainder of what I've overpaid for this policy is now going to that cash value bucket. And then on top of it, how can we get the best interest credit to that bucket as well? And the major difference of what we did was we just lowered that net amount at risk. So how does this cash value grow? And if you think of this kind of like a little bucket, like a little funnel bucket, what happens is we're growing that cash value on two separate components. We're growing it with the net amount of dollars. We're reducing that death benefit as low as possible. We're reducing that net amount at risk as low as possible, so that in that example, the $1,000 that someone was placing in there, the smallest amount is going towards that cost of insurance and other expenses, and that remainder amount is going to the cash value. And then we have the second concept, which is the interest credit that you're going to receive into this bucket as well. So if we're reducing the net amount of risk and then we're honing in what gives us the best advantages for this interest credit, that's where you could go into specifically designed contracts, or that's where you could really maneuver your plans the correct way. What I mean by that is, if you have a fixed percentage rate, this is known as whole life. It's known as a dividend rate that gets paid back. If you have interest rates, which this was really attractive in the 1980s when they first came out, it was tied to interest rates. Unfortunately, now interest rates are at all-time lows. So therefore, universal life is really, I haven't seen that really come across that too much with just a plain universal life policy, because interest rates are so low right now. You could use VUL, variable universal life, which is tied to mutual funds, which is good when the market goes up, but horrible when the market goes down, because that's going to reduce, it's going to have a further negative to your actual cash value. And then our recommended options are typically the IUL route, the indexing, where it says this interest credit is either going to be positive up to a certain cap limit. We have caps as high as 17%. And whenever the market comes back negative, you're going to receive a gain of 0%. So your cash value is still going to be gaining, even in those negative market years, but you're going to be able to capture whenever the market does well. And those are known as indexing strategies. Now, some of the most common mistakes that are made is individuals are meeting with life insurance agents, and they'll call up a random company because they saw an advertisement about the life insurance. So, they're going to call company XYZ, and, to your surprise, the only contract they're going to be showing you is with that company XYZ. With these sorts of contracts, you have hundreds of them throughout the nation. So in your particular area is going to, and your particular age is going to determine which ones are going to be the best offerings. So if you have, company A that might give you cash value, let's say you have somebody that's 40 years old that they're putting $12,000 a year into this plan. Well, you could have company A that, even though you're trying to reduce that net amount at risk, by the time this person turns age 65, maybe they have $500,000 in cash value, as opposed to company B, which, because they're structured a specific way and they really hone in on reducing that net amount at risk, reducing those costs of insurance, company B could be providing the same individual with the same situation, the same rated carrier, $750,000, $1 million. That cash value growth is just one concept, it's just one piece of the puzzle. The second piece is what happens when you actually want to retire. How do you pull these monies out? And this is the mistake that's made, is many times I hear agents say, oh, just take a withdrawal and everything's tax-free. And that's not the case. You have a lot of different accounting factors that come into play. You could either take it out in the form of a loan, you could do a 1035 exchange, you could pull out first in, first out, meaning withdrawals up to whatever your cost basis was, and then you trigger a loan provision. So there's a couple of different concepts that you want to be mindful of by the time you want to pull these monies out, by the time you hit your desired retirement age. The most important factors, though, is making sure that you're paying the cheapest amount of costs, that you're throwing whatever that dollar is on a monthly basis, and you're able to look underneath the hood. We have a software tool, it's known as a Retire Sharp planning system, where we do straight comparisons if you're looking to throw it into brokerage accounts, if you're looking to throw it into 401k related accounts, if you're looking to throw it into, company A as versus company B, what are the exact expenses to the decimal point that you could place in there? What are the exact cap rates? What are the exact spread rates with these types of contracts? What I mean by that is, when I pulled up that funnel, we understand that if we're reducing the net amount of risk, obviously more dollars are going to go into that cash value bucket, right? But the other component, this interest credit, if you have a company that has a 9% cap rate versus a company that has a 17% cap rate, that's a huge difference when you're looking at the market. Because if, let's say the market does 12%, 15%, then it loses 20%, this company A is only going to gain 9, and then it's going to gain 0. This company B is going to gain 12%, 15%, 0%. So you're having a large difference of 18% as opposed to 27% of just that really quick smaller cap rate or larger cap rate with the other carrier. So how exactly can we push this limit to accentuate that cash value? And then when it comes time to pull those monies from the cash value, which one gives you the best loan provisions, available? Some of the biggest downsides to these plans, or what you're going to read about, is that the agent makes a lot of commission. And what we do is we actually have a tool that shows you what our exact compensation is. And what's the difference of the compensation when you're trying to set up a regular death benefit plan and then trying to structure in the cash value maximization plan specific to a Fosse Financial Group and a Retire Sharp planning system. And we also include the cost of charges chart, which I'm hearing is very rare for agents to do so. So you're able to see every dollar, every expense with any year. We could actually do a snapshot of that year, and then when we do the comparison, we could say, hey, if you were getting set up in a brokerage account, this is how much you're paying in expenses versus an IUL plan. So the way that those types of 702J retirement plans work is they're going to be front-end loaded in the beginning, and then there's going to be a certain break-even point at that 7-year mark, at that 10-year mark, at that 12-year mark, where it makes a lot more sense to go with this overfunded type plan. So it also depends upon the amount of dollars you're placing in. The more you're placing in, the more you can get out of that type of plan. The power of compound interest, because all those costs of insurance and all those expenses are paid in the beginning. So it's just, to see the exact comparison to the technical details, I think does make sense with these types of plans. So every dollar that's going in, what you can expect. We're showing low assumptive rates of return just to under promise, over deliver on what this is historically shown in the past versus what we're trying to show you on an illustrative standpoint, so you'd be that much more satisfied, the more and more growth that you're receiving in this plan. So I hope that all of this made sense. If you're interested in speaking with a specialist, simply call 1-800-566-1002. We're available 24 hours a day, 7 days a week. And what you can expect is when you speak to our assistant, say that you're interested, you saw a video online, you're looking at a 702 plan or 7702 plan, and that assistant's going to patch you over to a specialist. The specialist is going to ask about your situation, what your goals are, and see exactly if one of these plans might be best for your situation, or just kind of doing that 30,000-foot view and saying, okay, where are the gaps? What exactly do you need to fill in those gaps? How can you have a comfortable retirement to make sure that you're receiving monies that are tax-free, making sure that it's beating the pace of inflation, making sure that it's eliminating market losses, and then further significantly reducing those expenses, as opposed to going into different brokerage accounts or different qualified retirement plans, giving you that flexibility. But once again, this sounds fantastic, but at the end of the day, these plans are set up more oftentimes than not in a very bad way, in a very bad situation. So when you open up the hood, and what our software tool allows us to do with a Retire Sharp planning system is really expose what the fees are and whether or not it makes sense, and when that break even does make sense when we're comparing it amongst all different avenues. So guys, I hope you found value in this video. Please feel free to subscribe, leave comments. We are A+ rated on the Better Business Bureau. It's because of our methodical process, and I really enjoy creating content for you guys. So I hope that this at least helped put some different things into perspective, and we look forward to hearing back from you. Thanks so much. Take care.